All right, let's dive into Bath and Body Works and their latest Q2 earnings call. Now, on the surface, everything looked pretty steady, right? But the market, well, the market did not agree. So we're going to unpack exactly what spooked investors and what the company's new game plan is. Let's get right into it.
Okay, here's the game plan. We'll start with the Q2 results, then get into the market's reaction. After that, it's all about the new CEO's playbook, the tariff and cost issues, and finally, we'll give you our take with a rating for the next call.
And boom, here it is, 6%. That's the number that really tells the story. Right after the earnings dropped, in pre-market trading, the stock took a 6% hit. That right there, that immediate gut punch, is the big mystery we're going to solve today.
And see, that's what's so weird about it. You look at the report. Revenue was solid, basically dead on with expectations. They even nudged up their full-year outlook. So what gives? Why did investors hit the sell button so hard? Let's figure it out.
Okay, first things first, let's get into the actual numbers for Q2. So check this out. The revenue number, $1.5 billion. That was pretty much exactly what everyone was expecting. Right on the money. But then you look at the earnings per share, 37 cents. They missed by just one single penny. And you know, in this kind of market, even a tiny miss on profit like that, it's a huge deal.
And when you dig a little deeper, you see this huge split. I mean, it's a tale of two businesses. Their actual physical stores in the US and Canada, doing great, up almost 5%. But their online business, wow, it completely fell off a cliff, down more than 10%. Management even said they're not satisfied. And yeah, you can see why. For investors who want to see a company that's firing on all cylinders, both online and in store, this is a massive red flag.
All right, so with those numbers in mind, let's really get into the why. Why did the market get so spooked when the top line looked okay?
And this slide just lays out the disconnect perfectly. You had management on the call trying to spin the positives, right? They're like, hey, we raised our guidance, we're buying back more stock, we've got these tariffs under control. But the market? The market was listening to a completely different tune. What investors heard was a really weak Q3 forecast way below last year. They saw operating costs creeping up, and they zeroed in on that big, scary tariff impact that's about to hit.
And you've got to remember the context here. This stock wasn't exactly a high flyer coming into this report. I mean, look at this. Over the last year, Bath and Body Works is down more than 7%, while the rest of the retail sector is actually up. So when you're already lagging the pack, investors are going to have a much shorter leash. They're just not going to forgive any bad news.
Okay, so let's shift gears and talk about the new guy in charge, CEO Daniel Heaf. He's only been in the job for a little over 100 days, but he's not wasting any time. He's already rolling out a plan to tackle these problems head-on.
And I gotta say, Heath was super direct on the earnings call, which was honestly refreshing. This quote gets right to the heart of it. He's basically saying, look, we're great at keeping our loyal customers, but we've totally dropped the ball on bringing in new people. And he's specifically calling out the younger Gen Z crowd. You know, the very people who are supposed to be their future.
So, how's he going to fix it? He's laid out what he calls 3 no-regret moves. Basically, these are the big, obvious things they have to do. Number 1, fix that terrible online experience we just talked about. Number 2, actually tell people why their products are good. You know, talk about the quality and why they work. And number 3, start selling their stuff in new places, not just their own stores. These aren't just little tweaks. This is about dragging the brand into the modern era.
And check this out. This is a perfect example of that third point. They're putting their products into 600 college bookstores. 600! They're partnering with Barnes & Noble and Follett to do it. Think about that. It's a super smart, low-cost way to get in front of 7 million young shoppers. That's exactly who they need to be talking to.
But, okay, even with a great game plan, you can't ignore the storm clouds on the horizon. The company is dealing with some major financial headwinds right now, and it's really putting the squeeze on their profits.
And here's the number that really got investors sweating. $85 million. That is the massive hit they're expecting to take on their gross profit just from tariffs for the full year. That is a huge weight on their bottom line. And this is exactly why that Q3 forecast was so weak. Get this, almost half of that entire year's tariff pain, $40 million, is all hitting in Q3, just one quarter. That's a 240 basis point hit to their margins. I mean, of course, the market got nervous about near-term profitability. And it's not just the tariffs. Their operating costs, what we call SG&A, are also climbing.
Now, some of this is good spending, right? They're investing in new stores outside of malls, which are more profitable, but that costs money up front. Plus, they're dealing with higher healthcare costs and putting money into new tech to back up the CEO's plan. It's that classic dilemma. You have to spend money now to make money later, but Wall Street is notoriously impatient and only cares about the now.
All right, so let's tie this all together and look forward. What do we think is going to happen on the next earnings call? And the big question, what's our final rating on this stock?
So, here's our prediction for Q3. We think sales will actually hit the high end of their guidance, so think closer to that plus 3% mark. Why? Because new stuff like their Disney villains and fall collections should get people into the stores. For earnings per share, we see them landing right inside their guided range. The tariff and cost issues are nasty, but at least they're a known quantity now. And because the stock already got hammered for that weak guidance, we think if they just meet these lowered expectations, the stock could be stable, maybe even get a little pop.
And because of all that, our official rating is outperform. Look, we think the market is getting way too caught up in the short-term pain of Q3. They're missing the bigger picture here, which is the new CEO's long-term plan. That push to finally connect with younger customers, that could be a total game changer, and we don't think it's priced into the stock yet.
So, what's the key thing you need to watch for? It's all about the holiday season, Q4. That's going to be the first real test. Can their new digital strategy and new marketing actually drive sales without having to slash prices? You know, those deep discounts that just kill their profits. If they can pull that off, it could be the sign that this turnaround is for real.
And of course, we have to say it, this is all just for informational purposes. This is not financial advice.